forexbrokers.net, and we continue the series of videos explaining technical analysis concepts, part of this Trading Academy. This time we'll deal with basic technical analysis concepts, ascending and descending triangles, rising and falling wedges, but also flags and pennants. Keep in mind that all the aspects discussed here are presented in the article coming with this in this Trading Academy, only making things a bit visual here, so the concepts are better to understand and assimilate by traders. An ascending triangle, like the name suggests, requires a bullish market, a bullish trend, and then suddenly the market forms or puts pressure against the horizontal line. Now, the principle of an ascending triangle appeared for the first time on the stock market many years, decades ago, and the volatility on the stock market back in that time and also today is less than the one we witnessed on today's forex market, currency market, and therefore it is normal to see spikes like this or dips like this, but overall look for a horizontal area, the market to form an A, B, C, D, E, 5 waves, 5 segments for the triangle before moving to the upside. The measure move of any ascending triangle is the length of its longest wave applied from the horizontal base to the upside. The stop loss always should be at the lowest point of the last wave, and obviously we should go with a risk-reward ratio that makes sense, namely this is the risk, and then we go for the 1 to 2 for as long as the measure move holds. And this is how an ascending triangle looks like, and the opposite is a descending triangle. Obviously you wait for the market to move in a bearish trend and to consolidate against the horizontal base before pushing lower. A wedge can be either rising or falling. The saying goes that a falling wedge like this one here is always rising, implying bullish conditions, or that a rising wedge is always falling, implying bearish conditions. A wedge always has 5 waves: 1, 2, 3, 4, 5. From the moment that the 2 to 4 trend line is being broken on the wedge, that's the entry place for a trend, for a trade. Ideally, the market comes and retests the 2 to 4 trend line before being rejected. There are 2 ways to trade a wedge. The conservative approach requires for the trader to wait for the price to exceed the highs in the previous 4th wave. Remember that in a bearish trend, or a bearish trend is formed by a series of lower lows and lower highs, lower lows and lower highs, and such a move here implies that that series is broken. The market then pushes to the upside for the reward, as you need a reward of 1 to 2 risk-reward ratio. This will be the entry, and then 1, and then this will be the reward. A conservative approach always calls for moving the stop loss to break even and booking half of the profits by the time that the market reaches 1-to-1 risk-reward ratio. Namely, when the price reaches the 1-1, or the reward equals the risk, book the profits, half of the profits. Then move the stop loss at break even, and that's a free trade with a free margin, or with a margin that is freed. You can use it in other trades. An aggressive approach means that traders wait for the price to pierce the 1 to 3 trend line, which happens often, almost always I would say so, and then to buy on this 1 to 3 trend line with a risk-reward ratio bigger than 1 to 3. And how to use that, how to set the risk? Well, simply measure the length of the last segment, and then to project it to the downside you have the risk, and then the reward 1, 2, 3 This will be the aggressive approach to trade rising or falling wedges. A flag is also a consolidation, but it's a consolidation that usually doesn't resemble a triangle, like in the case of an ascending or descending triangle. It's a sideways, either a sideways move or a move that goes into the opposite direction of the previous trend. The measure move of a bearish flag, or a bullish flag as a matter of fact, is the length of the pole projected from the downside, from its minimum point all the way to here. So that's the measure move of a bearish flag, with the risk being the distance from the highest point in the bearish flag till its starting point. A pennant, on the other hand, it does resemble a triangular formation, only that in this case it's a symmetrical triangle, and usually it shows the price building energy to break higher in a faster mode than when it breaks from an ascending or descending triangle. The pennant has an interesting element, that's the time element. So all you gotta do is to consider the measure move. This is the measure move, and project it to the upside from the moment that the upper side of the panel, the upper edge of the pennant is being broken. But the measure move must come in a specific time limit, namely measure the time that it took for the pennant, project it on the right side, and not only that the price needs to break higher, but it needs to reach that measure move in less than the time, less or equal the time that it took for the pennant to form. And that's how you trade pennants. Pennants do not form that often as bullish or bearish flags, as wedges, but they are one of the most powerful continuation patterns that exists. Thank you for being here. Bye-bye.